Before we begin, please note this video is for educational purposes only. I am sharing my personal analysis of the market, not providing financial advice. This is a chart showing the Nifty 50 index's recent price action. Just yesterday, the market looked incredibly strong. The index broke out of a falling channel and closed positively above the 23,600 mark, even forming a bullish piercing line pattern. Everything pointed to continued upward momentum. But overnight, the global picture fractured. The gift Nifty, an early indicator that previews how the Indian market will open, plummeted 500 points, pointing to a disastrous open near the 23,220 level. Traders who aggressively bought call options yesterday, betting the market would keep rising, are waking up entirely caught off guard. That technical support from yesterday has completely vanished. This 500-point drop marks a rare convergence, a three-pronged fundamental disaster striking global and domestic markets at the exact same moment. Late yesterday, the geopolitical conflict in the Middle East escalated sharply. In retaliation, Iranian ballistic missiles struck multiple targets, including Qatar's largest gas field. Following the strike, the Qatari government shut down gas field production. This sudden supply shock caused Brent crude oil prices to violently spike 8 to 9% overnight, surging from $101 to $110 per barrel. While oil spiked abroad, another shock hit the United States. The Producer Price Index, or PPI, which measures wholesale inflation before it reaches consumers, came in at a staggering 7%. Markets were expecting a minor 0.3% increase. This extremely high inflation data arrived right alongside the Federal Reserve's interest rate decision. The Fed kept rates unchanged, and Chairman Jerome Powell expressed intense concern over the uncertainty in global oil prices and how it prevents any near-term rate cuts. The combination of these factors triggered an immediate sell-off. The Dow Jones fell 1.6%, the S&P 500 dropped 1.4%, and the Nasdaq lost 1.5%. At the same time, the VIX, a metric measuring market volatility and investor fear, surged over 12%, crossing the critical 25 level. With energy supply chains disrupted and inflation refusing to cool down, the prospect of global market stability and near-term interest rate cuts has evaporated entirely. While the global setup deteriorated, a completely separate crisis emerged within India's own financial sector, right as the banking indices were showing strength. Last night, Tanu Chakrabarti suddenly resigned from his position as the part-time chairman of HDFC Bank, India's largest private sector lender. The resignation was unexpected, but the wording of his letter caused immediate panic. He explicitly stated that certain things he observed within the bank over the last 2 years violated his personal values and ethics. This is a comparative chart tracking the overnight performance of Indian bank ADRs, American depository receipts, which allow U.S. investors to trade foreign stocks. Following the letter's release, HDFC's ADR crashed 7.5%. To check if this was a sector-wide issue, we look at competitor ICICI Bank, which fell only 3%. The massive HDFC sell-off was an isolated reaction to severe governance concerns. When the largest private bank faces credible governance doubts, the heavy selling pressure acts as a destructive anchor, dragging down the entire domestic financial index. The final element of this setup lies in the derivative data, which reveals exactly who is caught on the wrong side of this morning's opening bell. This area chart visualizes foreign institutional investors' activity. For 14 consecutive sessions, they've been aggressively selling, pulling 2,700 crore rupees out. Directly opposite this exit, retail clients stubbornly held net positive long positions, pushing the put-call ratio up to 1.09. Digging into the open interest, the total number of outstanding derivative contracts, there is a massive concentration of vulnerable put writers sitting right at the 23,000 Nifty strike price, completely exposed. With the market opening violently 500 points lower, these retail buyers are severely underwater. Their forced liquidation and panic selling will instantly accelerate the market's downward momentum right out of the gate. Yesterday's bullish crossovers on the daily RSI and clean technical breakouts are entirely irrelevant this morning. The sheer weight of these macroeconomic and corporate shocks completely overrides the charts. For today's session, 23,000 will act as the ultimate psychological and option support line for Nifty. Any attempted intraday recovery will hit a hard resistance ceiling near the 23,800 mark. Bank Nifty faces a tough battle. The index must hold the 54,900 to 55,000 support zone, an area that will be relentlessly tested by the fallout from HDFC Bank's leadership crisis. Do not rely on traditional candlestick patterns today. The price action will be strictly dictated by live updates on Middle Eastern crude oil infrastructure and rapid shifts in investor sentiment. In a market suddenly overwhelmed by international missiles, high inflation spikes, and corporate governance scandals, capital preservation must be your priority. Focus on survival over aggressive trading.